Chapter 4 covers one of my favorite topics, taxes. We're going to focus on tax concepts for planning in Chapter 4. When you think about the U.S. economy, taxes are a huge or integral portion of the U.S. economy. So taxes are paid on earned income, consumer purchases, wealth transfers, and capital assets. So when you are earning income through your employer, you have to pay taxes. When we're consuming goods, we have to pay taxes. Wealth transfers, gift taxes, estate taxes, and even on capital assets, there's something called capital gain taxes that have to be paid. There's also special taxes paid on things such as alcohol, cigarette, gasoline, food, etc. Certain items have special taxes that have to be paid as well. Corporations have to pay taxes. Individuals pay taxes on their homes, and also in Missouri, we pay taxes on our vehicles. Now, these taxes are used by the different government organizations, federal, state, and local, to provide a variety of governmental services and programs. So, most individuals who have any type of earned income pay taxes at the federal level, state level, and sometimes even have to pay taxes at the local level. Okay? So when we look at the federal tax system, there's an organization that you've heard of called the Internal Revenue Service. Yes, better known as the IRS. When it comes to paying taxes, there's different ways tax to be paid. They can be paid at the time of the actual transaction. So you think about when you purchase an item, you're going to pay sales tax right then and there. Payroll taxes. So if you're paid weekly, bi-weekly, once a month, taxes are being withheld from your earnings through payroll withholdings. And if you are self-employed, you might make what we call estimated quarterly tax payments to the federal government. Typically, the calendar year ends on December 31st, and taxes are owed for individuals by April 15th of that following year. There are deductions for Social Security taxes and Medicare taxes. These deductions come out of what's known as our earned income, the income you earn from your salary, if you're paid a set amount per pay period, or from your wages, which means you are paid an hourly rate of pay. There was an act passed way back in the 1930s called the Federal Insurance Contribution Act. There are two types of taxes that we have to pay now because of that act, the Social Security tax and the Medicare tax. Social Security provides you with Social Security benefits or income once you reach the age of retirement, and you pay the Medicare tax so that upon the age of retirement, you're able to receive medical insurance coverage. Now, your employer also has to match whatever you pay for Social Security tax and Medicare tax. That combined rate is 6.2%. And I made some changes that may be good, may not be good as I thought about it, but it's done already. Because your book is showing these figures as of 2015. I'm showing the maximum earnings base as of 2018. So when it comes to paying the Social Security tax, there is a maximum earnings base, which means once your income exceeds that dollar amount, you're not required to pay for the rest of that tax year any more Social Security taxes. That amount as of 2018 is $128,400. Read your textbook to get the amount that it was as of 2015. With the Medicare tax, the tax is 1.45% on the total income that you earn for the year. So 6.2% is the tax rate for Social Security tax, 1.45% for Medicare tax. Now I'm going to try to do something. I'm going to try and write on this, on my slideshow using my Waco tablet. If I can only get this pen out of here. Hold on. It's coming. Okay, I'll go that way. Got it. All right. So let's see. Make sure we're still good. There we go. So we have 6.2% Social Security, 1.45 Medicare. When you add those together, it gives you 7.65%, which is the amount withheld from our check for Social Security taxes and for Medicare tax. But what about those individuals who are self-employed, meaning that you work for yourself? Well, remember that this 7.65% that's withheld from your earnings as an employee has to be matched by your employer. So when you are self-employed, you must pay both portions, both the employer's portions and the employee's portion. So if you take that 7.65% and multiply it times 2, it'll give you 15.3%, which we call in the accounting profession, that's known as self-employment tax. So when you are self-employed, you pay a tax at 15.3%, that's known as your self-employment taxes. Now on your personal income taxes, there are different types of tax forms. There's the 1040, the 1040A, and the 1040EZ. Depending upon the type of income that you earn, your deductions, etc., that will determine what type of form is the most appropriate for you to use when filing your tax return. The tax deadline date is April the 15th, unless it falls on the weekend, and then it could be later, such as the 17th or the 18th. Okay? Your filing status. This is extremely important when preparing your tax return. What is the appropriate filing status to choose? Well, on the IRS website, they have the rules that tell you what are the qualifications for these different filing status. So if you're not sure about your file single or head of household, married file jointly, married file separately, on the IRS website, they will give you the qualifications for these different filing status. Now, I know it's a little small to see. The top portion just has all of your personal information. I'm trying to draw again. Your name, social security number, etc. In this section, they ask about your filing status. So we go back. We talked about that, your filing status, where you file a single, head of household, etc. Exemptions, meaning are there, if so, an exemption means that if you've been claimed by someone else. So let's say you're a student, and which you all are students, and perhaps your parents claim you on their tax return, but yet you still earn some income for that year. You have to check that you were claimed by someone else on their tax return, and that's going to limit the amount of your deduction you're going to receive because you have been claimed by another taxpayer. Dependents. So this would be, say, if your parents were claiming preparing their taxes, you're their dependent, they will list their dependents in this section. The dependents are those who they take care of financially for more than half of the tax year. This section here shows income from the various sources that we'll talk about. These are adjustments from income to get what's known as your adjusted gross income. So we're going to list the different income sources. We'll talk about the adjustments from gross income to determine what would be your adjusted gross income. This next section, first you show the adjusted gross income from page 1, and then you have a choice, what we call a standard deduction or a itemized deduction. So based upon your filing status, head of household, single, married filing jointly, etc., there's a set amount you can deduct on your tax return for the standard deduction. Itemized deduction, we'll talk more about, means that you're going to list a number of taxable items that are deductible, and depending upon which is greater, you're going to either choose to itemize or take what's known as the standard deduction. In this section, there are some different credits that we'll talk a bit more about that can reduce the amount of taxes that you're going to owe. Sounds good. But then in this category, there are some other taxes that we have to add back in that can increase the amount that you owe. And then in this last section here where it says payments, let me get there, here we go. This will show the taxes withheld from your earnings already. It will show with estimated tax payments you may have paid if you're self-employed. It also shows certain type of credits which are going to be refundable, okay? And once you look at your tax liability, you look at any credits you may have qualified for, the end result will determine whether you have an overpayment, which is known as a refund, or if you have an underpayment and you're going to owe money to the federal government. So when it comes to gross income, we're saying what should be included in my gross income. It's going to be all reportable income, salaries, interest income, dividend income, capital gain from your investments. If you're self-employed, your self-employed income. Pretty much any income that you earn from any source should be included as gross income on your tax return. Now, there are certain adjustments from that gross income, things such as if you have to pay alimony payments, if you're paying interest on your student loans, if you're making contributions to a qualified individual retirement account. These types of items can reduce the gross income that's going to be shown on your tax return. Now, once you determine your adjusted gross income, as we talked about, you can either take the standard deduction, which is a fixed amount depending upon the filing status that you chose. That filing status from the standpoint of married filing jointly, married filing separately, single, or head of household. So depending upon which filing status you choose, that is going to impact the amount you're going to receive as a standard deduction. Okay? So here are the amounts for the standard deduction as of 2015. Now, there have been some huge changes for the 2018 tax year, but I don't want to confuse you, so I'm going to stick with the information in your textbook. So I didn't change the slide. I changed it, but I changed it back. So these were the deductions you would get for those different filing status in the year of 2015. I'm going to stop here so I don't make the video too long, and I'm going to make a second video continuing with this process of tax planning, tax preparation. Okay? Stay tuned for part 2 of the video on tax planning for chapter 4.